The Central Bank of Nigeria has increased its interest rates to 18% for the second time in 2023. The decision was made to combat inflation, which has been on the rise since the onset of the coronavirus pandemic. Inflation spiked to 6% in February and has proven difficult to control. The Apex Bank's Governor, Godwin Emefiele, disclosed this while reading the communique of the Second Monetary Policy Committee meeting of the year on Tuesday. Addressing journalists at the end of the two-day meeting in Abuja, Emefiele said the committee voted to keep the asymmetric corridor at plus 100 and minus 500 basis points around the MPR. The move comes after the United States Federal Reserve raised interest rates by 4.5 percentage points in just the past 12 months as it tries to slow down the economy and wrestle price increases under control. Now, the central bank's decision is expected to have a significant impact on Nigeria's economy. Higher interest rates make borrowing more expensive, which can lead to a slowdown in economic growth. However, it can also help reduce inflation by making it more expensive for people and businesses to borrow money. The monetary policy decision is expected to catch some businesses, investors, households, and experts who are actually surprised. And they are saying that the ability to retain the interest rates at the particular number that it is should be what should obtain for the Central Bank of Nigeria. Now, the CBN has been taking steps to address inflation since last year when it introduced measures such as restricting access to foreign exchange for certain imports and increasing lending rates. Despite these efforts, inflation has continued to rise, leading the bank to take further action. This morning, before I bring my guest on board, we take a particular report talking about central bank's interest rate hike.
The committee therefore decided to sustain the current stance of policy at this point in time to further rein in inflation aggressively. One member voted to increase the MPR by 150 basis points, 4 members by 50 basis points, and 7 members by 100 basis points. In summary, MPC voted to 1. Raise MPR to 17.5%, 2. Retain the asymmetric corridor at plus 100 and minus 700 basis points around the corridor, and 3. Retain the CRR at 2.5%, and 4. Retain the liquidity ratio at 30%.
And that is the Apex Bank Governor, Godwin Emefiele. They're talking about the newest rate hike that the MPC has come up with. And so joining me from London, UK, is Gospel Obele, who is the Chief Economist at Streetnomics Limited. Thank you so much, Gospel, for joining us once again on the show.
Thank you for having me, Lekan. Great to speak with you again today.
All right, beautiful. So this is not the first time that the CBN will be raising the interest rates this year. The first time was in January 24, where it was raised from 16.6% to 17.5%. But I'd like to ask, between January 24 and now, what's changed? What impact did that hike in interest rate have on inflation and the economy?
Yes, a lot of things have changed in the global financial system, and it's safe to say that since the moment interest rates started going up in 2022, we've seen that there's been a divergence in terms of interest rates have favored the financial markets and the global banking sector than the real sector and than economic growth to a very large extent. And within the context of what has happened the last 1 month, looking at what has happened with the SVB and the recent purchase of Credit Suisse, we've also seen that there is some form of threat within the global banking system, of which the interest rates have been in favor for in the last 1 year. So it's very important to create that introduction so that it's a lot easier for people to understand what's going on in context to why we're not seeing the impact in terms of real sector and economic growth. So those two major events have occurred in the last 8 to 10 weeks so far in the year 2023. And in terms of sort of providing a preventive measure, in such a way that the central bank is in a safe place in terms of financial soundness and in consistency to what may happen in the global markets, all right, being the fact that the Fed is likely going to make some interesting decisions around what's happened as well in the banking sector. within that ground, it makes sense for the central bank. But in context to economic growth and the real sector, we have not seen, the impact of increased interest rates within the last 1 year. And also safe to say that within the context of interest rates, the fact that a lot of things are happening and directly impacting the real sector are more nuanced around structural and policy misalignment than just interest rates themselves. All right, if you look at food inflation right now, if you look at exchange rate, if you look at the new note saga, if you look at how the general elections went down, and all of those narratives, internal in the Nigerian economy, you'll see that we have more to do structurally than just interest rates that's currently impacting on the real sector. And of course, the interest rates themselves have also increased what we term as creating a new level of barriers, to access to finance and to financial inclusion, in context so people cannot access their own monies this time, as well as even other deposit money operators have not been able to live up to the standards of a quote unquote a cashless economy in the context of a new central bank policy. So these are the evolving narrative, and sometime in February also, the world globally reckoned the fact that we hit a 1 year milestone in terms of anniversary of the Russian invasion on Ukraine. And projectors have seen that it looks as though Russia is not, settling anytime soon with regards to its invasion in Ukraine. So that also brings a lot of uncertainties, plus or minus geopolitical tensions, across productive regions in the world. So if you look at all these dynamics, there's more chaos than we had in 2022. And the central bank sort of has decided to go more preventive in its control measures at the expense of the real sector.
Well, I'm actually glad that you talked about how it is affecting the naira, foreign exchange, and the value of the naira, because that's actually where I'm going now. We understand that the NPR has been on the rise since April 2022, when it was 11.50%. But now that it's been pushed up to 18%, the question is, do you think it will actually reduce or ease the pressure on the naira in terms of value, scarcity, availability, and of course, the foreign exchange that you mentioned?
Yeah, thanks a lot for the question. I do not think it will make anything better for the value of the currency. The value of your currency is a function of two conditions. Number one, how productive you are both locally and how productive you are in context of regional and global markets. All right. So on the grounds of the necessary conditions to achieve productivity, we are not in any way close to that yet. There's still a lot of things that needs to be done. From a political will and reform standpoint to engineering the infrastructural and institutional elements that drive productivity to a very large extent. So until we achieve the productivity question on the necessary condition block, we may not achieve any form of increased or improved positioning of the naira. Secondly, is how competitive is your economy to an extent that your institutions are strong enough to protect your currency in the context of the global currency wars. All right, the Fed Bank and the Chinese bank and all the likes are constantly, the ECB, the Bank of England, are constantly pushing heavily to protect your currency, in the context of global narratives, global tensions, and all the likes. And I've not seen any strategic move by the Nigerian Central Bank, to protect the currency and to argue for its position globally, within the context of deals, within the context of, bond arrangements and all of these global dynamics that sort of positions these other currencies stronger over the naira constantly over time. So until we achieve the productivity block, which is powering up SMEs, ensuring you have ease of doing business, ensuring that your markets are more competitive, and then until we achieve the institutional positioning for the naira and protecting the naira within the global context of conversations and negotiations, I do not think we're going to achieve any strong footing in terms of value of the currency, regardless of what the interest rate is locally.
Okay, so I'm guessing you have a crystal ball before you, because it seems like you're already pitching into my next line of question, gospel. Well, of course, when interest rate increases, it also tends to lead to increase in lending rates. And you talked about SMEs and how it's affecting business, and that's where I'm going now. Firstly, do you think that it is sort of affecting those who are borrowing money, those who've been borrowing money over time? Do you think that the increase in interest rates is affecting them or deterring them from borrowing money? And how does it also affect these SMEs who from time to time try to access credit facilities and try to expand their operations? Now, wouldn't that also have an adverse effect on these SMEs in terms of these areas?
Yes, I mean it's having adverse effects across board, both for corporates and retail institutions and even SMEs, right? Majority of persons who are currently have loan engagements or lending engagements with banking institutions have had to probably restructure their loan agreements or find a safe landing in the context of growing interest rates in the last 1 year. So that's one part. And secondly, yes, it also deters people from engaging with the financial sector as a major as a go-to, for lending and all that, being the rising interest rates. I mean, with the current trend, there's just a scare around how much more, how far will the central bank raise interest rates further. It's also very critical for us to note that this is also going to impact on our credit economy and a credit culture. You cannot necessarily build a financial system, to become very robust and influential without a very, very solid credit structure or credit economy in this context. And this is going to affect that linkage with the financial system. On the bit of SMEs, I mean, we did a study for Faith Foundation on the state of entrepreneurship in Nigeria and realized that increasingly in the past 2 years, there's a growing decline of SMEs who want to associate with the financial system as a conventional go-to place, to raise funding or to lend monies and all that. One of the outside the convention of high interest rates and severe collateral risk and all of that, you also have the conversation around the fact that the financial system in Nigeria is not stable and interest rates have been also increasing. So you realize that SMEs are now looking for much more innovative ways to lend, and to pay back, in a much more convenient way. So you see that the rise of fintech lending for SMEs, which again has its own risk. You're also seeing the rise of, family and friends, structured cooperative society lending platforms as well. So SMEs are looking for more creative ways to engage with the lending economy. And that also creates a form of opportunity for people who want to play in that sector. But again, comes with its own high risk, being the fact that we are facing a global liquidity crunch on many grounds. Yeah.
All right. So even as we are experiencing economic instability in our economic space, we're also having issues of the dwindling foreign reserve, which, according to reports, was pegged at $37.04 billion US as of January this year, and it reduced to $36.7 billion US as of February this year, just within a space of a few weeks. Yeah. So I'd like to know, what is the state of the health of Nigeria's foreign reserve, looking at the size of the economy?
Well, there are a lot of questions to the foreign reserves. One of is the fact that we have a very poor revenue mobilization strategy and structure in Nigeria has also affected our potential to convert into reserves, to start with. So the headline argument, many times, is the fact that global oil prices are dwindling in one way or the other, and it hasn't necessarily been in favor of the Nigerian economy. And that's to a very large extent where we get our reserves from, right? But if you now look at the structure of the Nigerian economy, which is almost 95% non-oil, it means that if that non-oil sector can be properly organized and invested in, there is a strong future, or there is a very bright future for external reserves going forward. The challenge has been that the reserves have been looked at from one angle, which is oil, and the story around the reserves have been looked at from one angle, which again is oil. So if you look at it from that context, there are fears and concerns around a dropping or a dwindling FX reserve, foreign exchange reserve in Nigeria. But I'm saying that the story is a bit different when you look at it from the potential of what or how much we can make in reserves, or have in reserves, if we begin to structure and invest into the non-oil sector some more. And let me also say that it's also a function of that productivity dynamics I talked about on the currency question. Once the economy is very productive, especially being the fact that it is currently diversified, All right. It means that we're going to have a lot of gains from the non-oil sector interacting with the regional and global markets. And if the institutional dynamics and the value chains across that are done properly, all right, we should be able to gain some more foreign exchange, from that block rather than just oil. So we have a lot of low-hanging fruits, but requires a very strategic, visionary, and leadership with that capability to put it together and make sense out of it. So again, the foreign exchange reserve story is incomplete without looking at the potential of the wings of the table in terms of low-hanging fruits.
All right, let's break it down and make it more understandable for the layman on the streets, because an ordinary Nigerian would have to deal with the issue of the hike in the cost of food prices in the market, deal with the hike in the cost of fuel purchase, and of course for businesses they'll have to also deal with the problem of forex scarcity, even as you have mentioned. So when it comes to market stability and growing the economy, having an appreciable growth in the economy, what do you think the Central Bank of Nigeria should be putting into consideration aside from interest rate hikes?
First and foremost, the central bank cannot do it alone. And one of the reasons why we're in the mess we are in today is that the central bank has taken a lot of things that primarily doesn't fit within its JD as that an apex monetary institution. However, within the context of evolving economics and how economics has probably evolved in the times we live in, if we're being very honest with ourselves, then it's very, very important that we begin to look at not just a coordination among the central bank and the fiscal authorities, but rather to understand that the roles may have shifted in one way or the other. So what have they shifted to, and what are the new limits to where the central bank can engage? We need to have that definition. We need to understand that, because not being able to put that into context has also affected the narrative and the use of interest rates. I think interest rates globally have been misused, or quote unquote, assumed to be the one and only solution around the inflationary crisis we face. The inflation we deal with today, just like in 2019, nobody ever believed in 2019 that a global health pandemic could have led to a global recession. Nobody ever believed it. You would want to think that a financial crisis or an economic crisis would lead to an economic recession. But we are in the times when things are now very, very intertwined, in context to impact outcomes, output, and all that. So it's very critical for us to understand that interest rates alone cannot deal with the nuance or nature of inflation we're currently dealing with. Because that inflation, within that context of inflation, you have structural issues, you have geopolitical issues, you have imported inflationary risk, and many other things that the interest rates cannot deal with, or rather, I would like to say it's out of reach for the interest rate and what interest rates can do. So it makes sense for us to begin to review what can interest rate do and how much further can the monetary institution go within the context of what it's being designed to achieve. And then what's the new role, going forward for the fiscal authorities in managing these new menace we're faced with. And then what should coordination look like, between the fiscal and the monetary authority. So these are very interesting questions forward-thinking economists should be thinking about, forward-thinking institutions and nations should be thinking about, if we must have a much more sustainable approach to dealing with this problem. Otherwise, we'll keep increasing interest rates in favor of the financial institutions, maybe, but at the risk of economic growth and real sector development.
All right. Well, even as we talk about this, Gospel, we still have issues with the lingering petrol scarcity and the possibility that subsidy removal will come into being finally between now and May. Of course, according to reports, it cost about $10 billion to the Nigerian government. And also, there's the speculation that value-added tax will be increased from 7.5% to about 10%. That is the postulation. And we are having a new administration coming on board. What do you think Nigerians should expect? Because what we're talking about is how to curb inflation. But then when we have these situations not being dealt with critically, then it kind of brings about some sort of deceit in our monetary policies and implementation trajectory.
Yes, I agree with you. If you look at the track record of the president-elect, all things being equal, he resumes office. There's likely going to be a lot of structuring and revenue mobilization. And one of these things would be an increase in VAT to a very large extent. So Nigerians need to get ready for that. and businesses, stakeholders need to get ready for that. And probably a review of the comprehensive tax and revenue engagement structure in one way or the other. So that's one thing that is really valued on the table. Secondly, is the fact that I think with the recent months of fuel scarcity and all that, Nigerians have had to buy fuel at ridiculously high amounts, which technically would mean that if subsidy were rolled out, that would be the new reality we'll be dealing with. So we are already in that reality. We'll probably just need the mention or the announcement that subsidy has been taken out. However, I'm of the school of thought that subsidy should be taken out in phases.
But we've had that. We've had that over time in the previous administration, where we've had talks saying that subsidy had been removed at a particular time within a particular frame, and it's been gradual, if you would agree with me. So when you talk about it being gradual again, how gradual can this gradual process be?
So there's an argument that it should just be taken off once and for all.
Okay.
But I personally don't believe that the argument is for subsidy. I'm just trying to speak within the context. I do not believe that the argument for subsidy. So, for instance, the reason why you have subsidy is because you have a high demand on PMS, and you're not producing locally to meet that demand. So, because you're importing and you're dealing with the value chain cost of, importing your already, crude oil that you produce here, that would mean that because you're also faced with increasing local demand, the average household spends almost 20 liters of fuel every week. Not to talk about the average business in Nigeria and all of that. So when you put that together, that's a huge local demand for PMS. All right. When you juxtapose that with the fact that we're increasing these things at significant volumes, all right, and we're not refining any of these things locally, that would mean that the only way to ensure that the increased cost or the increased imported cost does not transfer to the average Nigerian is to introduce subsidy. So if you fix, which again is not a big deal, because if you can have a private refinery up and running and everybody's going to the site every day to do their checks, then we should be able to have some of the refineries at home working, or find ways to convert the illegal refineries to legal or semi-legal refineries, something like that, so that you can also cut down on how much you're spending to import and meet local demand. On the flip side of things, if you fix power by 50%, you would have a situation where household consumption of PMS may reduce from 20 liters per week to at least about 10 to 8 liters per week, if any. I don't know if you get what I'm saying. So that already reduces the local demand and also the pressure on how much volume we need to import. So if you look at the economics of this whole subsidy conversation, the argument is really not subsidy. The argument is the fact that we failed to not just fix power, but also fix our local refineries. As a result, there's a lot of pressure on subsidy and the subsidy conversation itself. However, would it make sense to take it off as a one-off? Again, I do not think so. Yes, you may say that it's been reeled out in phases in the past and it has not done much. But if you look at the pain and the stress or the strain that the average Nigerian is going through right now, an outright 100% removal is going to make things really, really worse. Ideally, things are already really bad. So again, it's still a conversation of what's priority for the president-elect to a very large extent.
All right. Well, of course, Gospel, talking about inflation, Nigeria is not the isolated case. Well, when we talk about this, of course, the UK is also grappling with this. Well, the Federal Reserve is also trying to increase the interest rates. US is also battling with the issue of inflation. But then everywhere. I think for all you've said, what is important is for the CBN to look at the Nigerian market dynamics and prioritize and look at what works for Nigeria so that it can bring some sort of benefits to it. Thank you so much, Gospel. Really appreciate your presence.
Thank you for having me today. Have a good day, Lekan.
And you too, my brother.